much. I show that it is 2 o'clock on the dot, so we want to be respectful of everyone's time. If you haven't attended my webinars in a while or at all, a couple of housekeeping items. We go through the presentation, but you're welcome to put a question in the chat box. These presentations are recorded and posted online at our townbenefits.com site, and you will also, anyone who registered will receive a copy of the slides from the presentation. So with that, let's get started. We're talking, I can't believe it's around that time of year again, but we're talking about the applicable large employers reporting for calendar year 2023. And I'm Corbin Granger. I'm a Senior Vice President here at Town Benefits. And so we're going to just go through some of the mechanics of this reporting. Please note, this is based on, the current IRS information. So this is not legal or tax advice. This doesn't include specific things like multi-employer plan reporting, some alternate ways of furnishing the 1095-C or some of the fancier mechanisms that you can use with this reporting. This is really designed to explain the codes, to make sense of the codes, what the IRS is looking for. And so as you're working with your payroll provider or your reporting provider, when you're given that information to confirm, you can be confident knowing, okay, I understand what they're asking me. So with that, let's get started. So in 2023, last year, they issued a pending rule, and they permanently extended providing the statements to individuals. So it used to be January 31st, and they would continually extend it. So now the due date for providing individual statements, which is the 1095-C, is March 4th, 2024, okay? Filing with the IRS, the 1094 and 1095-C, the due date for filing electronically is March 31st, 2024. However, if anyone on the line has filed in the past in paper, if you file more than 10 returns for your entire entity, so I'm talking 1099s, even your 1094, 1095 forms, you are required to file electronically. So if you have filed in the paper in the past, that will no longer be permissible. The IRS wants these filings electronically. So just to touch on the ACA affordability percentages moving forward, this is for plan years on or after January 1, 2024. You'll be reporting this year based on 9.12% of income as defined by one of 3 safe harbors. Next year, it does go down to 8.39%, and that's 8.39% of Box 1 W-2 income. That safe harbor must be used for all months the employee was offered coverage or not at all. So when you're reporting for a calendar year, you can't combine Box 1 W-2 with the rate of pay safe harbor. It has to be consistent. It's 8.39% of the employee's rate of pay times 30 hours per week or 130 hours per month, or 8.39% of the federal poverty level for the year. And that's based at 14,580 or 101.94 in 2024, okay? So what are the penalties? Just a quick reminder, they're called the 4980HA, which is also referred to as the nuclear penalty. And this is issued failure to offer what's called minimum essential coverage. That's the lowest level of coverage to 95% of employees and dependents. Failure to offer coverage does not automatically generate a penalty. The penalty is always triggered by one full-time employee receiving a marketplace subsidy, but somebody will be receiving a marketplace subsidy. So it's very important that the employer be able to prove that they're offering coverage to really 100% of their full-time employees and dependents. The penalty for 2024 is $2,970 if it's for the whole year, times the number of full-time employees minus the first 30, or if assessed monthly, it's $247.50 a month. Now, assessment is entity by entity within a controlled group, so the minus 30 full-time employees must be shared within the control group. So it's not like each entity within the control group gets minus 30. They're apportioned out based upon a number of factors. So the 4980HB penalty, we usually refer to it as the unaffordable penalty. And that's triggered if a full-time employee receives a marketplace subsidy because the offer was either not affordable, and as we defined it on the previous slides, based on box 1 W2 rate of pay or federal poverty level, for calendar year 2023, the percentage is 9.12%, or it's not minimum value. So this penalty has gone up substantially. This penalty is $4,460 per full-time employee that receives a subsidy, and it's assessed monthly, $371.67. And again, the assessment would be entity by entity within a control group. So the goal today is how to illustrate the reporting and how to understand the reporting so that you don't have to worry about getting one of those pesky IRS letters, 3 years down the line and then having to defend it. So let's talk a little bit about the purpose of these forms. So the 1094C is really the cover sheet. It's the electronic cover sheet moving forward that you use to tell the IRS, hey, this is coming from ABC company, and all of these 1095Cs are our employees. It's also used, as you'll see in a moment, to calculate the nuclear penalty, because on the 1094C, there's a question, and you're reporting whether you did offer minimum essential coverage to 95% of full-time employees and dependents for every month of the calendar year. So that form is strictly for that. Let's look at it quickly. The 1094C Part 1, and again, you'd be doing this electronically. Lines 1 through 16, all of your ALE information. On line 18, you're going to indicate the number of 1095Cs submitting. So obviously, you do the 1095Cs first before doing the transmittal form. And on line 19, if you're a member of a controlled group, each entity within that control group must have its own authoritative transmittal. You don't combine them. The reporting for large employers is by EIN number. So under Part 2, you complete the number of forms again that accompany the transmittal. And are you a member of an aggregated ALE group? So are you a member of a control group? If the answer is yes, you put yes. If the answer is no, it's just you, then you do no. Now, line 22 can sometimes be confusing, but it just represents optional ways to file the 1094C. So if neither A nor D applies, it may be left blank. And of course, the signature of the responsible individual e-filing the form. So what is A, the qualifying offer method? It's a specific method. It means the employer is using the federal poverty level safe harbor for all months of the year. So it doesn't mean, yes, I'm offering coverage that qualifies under ACA. It means to the employer, I'm offering coverage where I'm not charging any more than the federal poverty level safe harbor for that year. And the offer, and there's at least an offer of what they call minimum essential coverage to the spouse and dependents. So if you're using the federal poverty level safe harbor, but you're offering a conditional offer to the spouses, you can't use 1A, okay? It's really the lowest level offer. It's what the IRS considers a federal fail-safe for affordability. The 98% offer method just means that you're offering affordable minimum value coverage to at least 90% of the people for whom you're filing the 1095C. Ideally, it should be 100% of the people. So if you offer coverage to some part-time people, this is really intended for that purpose. You must have an offer at least to the employee's dependents. And what is your reward for using the 98% method? You're not required to complete column B on the 1094C. And what that means is you don't have to list full-time employees each month. You do still have to do the next column where you list total employees. But that's the benefit of the 98% offer method. So here we are on part 3. So remember I said the minimum essential coverage offer indicator, you have to report yes for all months the employer offered minimum essential coverage to 95% of full-time employees and dependents, or no for any month the employer did not offer coverage. Now, this is sometimes something that trips people up, that yes, they're offering minimum essential coverage. They're doing it all year, but for some reason they check the no box. And when you check the no box, you are going to reward yourself with a penalty a couple of years later, or a penalty letter, and then we have to explain it. So keep in mind, unless you're not offering coverage or you weren't in existence, maybe, everybody should be able to check the all 12-month box, but you have to report honestly what you are offering. Now, under B, that's where you do the full-time count for the member. So again, that's only if you're not using the 98% offer method that I just mentioned. So you list all full-time accessible employees that month using the monthly measurement or look-back method. So if you're using the 98% offer method, you can actually skip column B. Column C is the total employee count, and you report the total number of employees, and of course the IRS has a method for doing this. The last day of the month, for some reason the 12th day of the month, or the first day of the first payroll period in the month, or the last day of the first payroll period, if that falls in the calendar month when the payroll period starts. I say it might just be easier to go with either the first or the last day of the month. D, you only complete if the member is a member of an aggregated ALE group or a control group in any months or all months. So maybe you've been related to other entities for all 12 months. Maybe you've only been related to other entities for 5 months. So it gives you the option of doing all 12 months or actually going through each month. And again, that only applies if you're a member of an aggregated control group. And E is no longer necessary, so they just use it as reserved. On part 4, this is where you actually self-identify the other members of the aggregated ALE group. So if you're company A, then company A, and you have company B and C as part of your group, then company A is going to list B and C, company B is going to list A and C, C is going to list A and B. It does not apply again if you're the only entity filing and you're not related to any other members of a control group. Again, after completing it, then it's going to be transmitted electronically to the IRS. So what is the 1095-C? The 1095-C is used for a different reason. It's used to report offers of coverage to every employee that qualified as full-time for 1 or more months in the calendar year. So if you had somebody that was in a measurement period all calendar year, they never achieved full-time status and they don't get a 1095-C. And if it's self-insured, if your plan is self-insured, it's going to show enrollment in coverage of employees and what they call non-employees. So plans that are fully insured for the entire calendar year only complete parts 1 and 3. Plans that are self-insured for any months of the calendar year must also complete part 3 for individuals. So that means your spouse and dependents that are enrolled in any month of the year. So let's say you had a fully insured plan from January through June of 2023, but then June of 2023, you became a self-insured plan. You'll have to report under part 3 all the covered individuals from June through December of 2023. For the previous 6 months, that information will come from the health insurance carrier. So let's go over the 1095-C, and it's part 1 and part 2. And again, unless you're self-insured for any months during the calendar year, these are the only sections you're going to complete. Okay, so this is what it looks like. So you have part 1 with the employee's information, then you have part 2 with the applicable large employer information, and then you have the offer of coverage information. And that's really the crux of this form. line 14, line 15, and line 16. And that's what we're going to talk about now. We're going to go through each line. So line 14, so the fields. Let me go back for a second. So you can see under part 2, you have employee offer of coverage, employee's age on January 1, and plan start month and zip code. So let's look at those fields first. Employee's age on January 1 is only completed if the individual was offered an individual coverage HRA, or what we call an ICRA. The plan start month is required, so you have to enter the number 01 through 12 for the calendar month when the plan year begins of the health plan for which the employee is eligible for coverage or would be offered for coverage. This isn't when the employee starts. This is when your plan year starts. So if your plan year starts January 1 each year, then you're going to use 01 for everybody. If you hire me 6 months later in June, you're not going to use June 1. Your plan year is still January 1. If more than one plan year can apply, like your plan year was changed, list the earliest month. If there's no health plan that you're offering, so you're reporting here that you're not offering health coverage at all, and really everyone on the line should be reporting health coverage, then you would use 00. Line 17 is a zip code that is only used if the individual was offered an ICRA. And there's a lot of codes for calculating the required contribution on line 15. It's either going to be the zip code of the employee's residence or the zip code of the primary site of employment. We have a lot of new series codes created for that. Very, very important. Line 14, you never leave it blank. Even if the employer did not employ the employee that month, there is a code that applies. It's 1H. You enter the code that applies for that month, or if the same code applies for all 12 months, you may use the all 12 month box. So you'll see in a second, I'll have somebody where the code applies all 12 months and then someone where the code changes because they were hired in the middle of the year. An offer of health coverage must be valid for the entire month. So if the offer of coverage or the coverage actually terminates before the last day of the month, because the employee terminates during that month, the employee does not have an offer of coverage for that month. You would use code 1H. And so why is that? That is because if the person leaves in the middle of the month, they're no longer your, what they call, quote unquote, accessible employee. So you're no longer responsible for a penalty. So you put 1H that you're not offering them coverage. And then you put on line 16 a code that explains why. So here are the line 14 codes. You've got qualifying offer, employee only, employee plus dependents, employee plus spouse, family, 1E. You've got 1F for only offering a MEC. You've got 1G where you're offering coverage who wasn't full-time any month, but they enrolled in a self-insured plan. You have 1H, no offer. You have 1J, which is an employee and conditional offer to spouse, but you're not offering to dependents. And 1K with employee independence with conditional offer to spouse. Now, under ACA for your full-time employees, there are only certain codes that are going to apply, really like 1E, 1H, 1F, and 1K. So you have a 1H no offer code. And I think sometimes people get confused and say, well, I don't want to say that I'm not offering coverage. But really, you're going to pair that with the appropriate line 16 2 series code. So 1H, you didn't offer that person coverage that month. Why? Because they were in what we call a limited non-assessment period. They were being measured or they were being in a waiting period, or it was the first month of employment if you're not offering them coverage at all. 1H, you didn't offer them coverage. 2B, because they were part-time that month, and that really means that they're part-time. So if somebody's in a stability period as full-time, but their hours get reduced, that's not a 2B. Or really what you use 2B for a lot is the month of termination if the employee terminated before the end of the month and they weren't enrolled until the end of the month, or if the offer stopped before the end of the month. Because again, 1H, 2B means I'm not offering them coverage because this is the month they terminated. They left in the middle of the month. and they were no longer my assessable employee as of the middle of the month. 2A applies if the employee was not employed on any day in the month. So sometimes people get confused and they use 2A the month the person terminates, but they can't have worked for that employer on any day in that month. All right, so line 14 codes again, 1A through 1K. It's always reflecting the highest tier of coverage offered. So 1A, as I've already said, is a qualifying offer code. That is a very specific code. You have to use the federal poverty level safe harbor, which is 10328 for 2023. The offer has to include the spouse and dependents, and then you leave line 15 blank, and you have an option to leave line 16 blank. Most clients will use 1E, family coverage, and that's going to be combined with your line 16, 2C for enrolling, or one of your affordability safe harbor codes, 2F, 2G, or 2H. If you are an employer where you're only offering MEC, there is no 2 series code permitted, because if the employee doesn't accept your MEC, they can go to the marketplace and you would be assessed a penalty. 1K is employee independence with a conditional offer to a spouse. And again, like 1E, that's going to be combined with a line 16, 2C, 2F, 2G, or 2H. Now, if you're failing the minimum essential coverage offer test in a month, you're not allowed to use any of the line 16 codes, but everybody in the line should be offering coverage that meets the 95% test. I'm not going to go through these one by one, but these are the codes that you use. They're either based on the employee's zip code, they're, who you're giving an offer to. Is it based upon the zip code or the employment site? So those are your ICRA codes. All right, so on line 14, again, we're issuing the highest tier of coverage offered. And in this case, we're going to show all 12 months. So an employee has been there for a while. They were offered a minimum value plan for all of calendar year 2023, and that's going to cover the entire family, okay? Doesn't matter who enrolls, doesn't matter. That's the highest tier of coverage you're offering to that employee. So it's 1E. Now, if it was based upon the federal poverty level safe harbor and you made the offer to the spouse and the dependents, then you could use 1A. Now, let's give you an example of line 14, which is not for all 12 months. So this shows you how you use your 1H and your 1E codes, or your offer code. So Tom here is not an employee in January of 2023. So that's 1H. You don't have anything to offer Tom because he wasn't even employed. The Levon Helm Company hired Tom on February 10th, 2023. So they have a waiting period of the first day of the month following the date of hire. So again, Tom is not offered anything. March, well, March is the first day of the month following the date of hire. So now the code changes to the highest tier of coverage that was offered to Tom's family, which in this case is 1E. So you're either going to use 1H if you don't have an offer all year because somebody wasn't employed or they left in the middle of the year, and whatever your offer code is, or you're probably going to use the all 12 months. Line 15 shows the lowest self-only cost. So it's the self-only cost of the lowest plan offered. So in this example, Levon Helm Company offers Tom an HMO for $200 a month, and that's the self-only, and a PPO for $275 a month. And this offer is from March through December of 2023. Well, the HMO is the lowest cost plan, so that's what you're going to report. So you can see the magic here. You're not really reporting what the employee is enrolling in. You're showing the highest tier of coverage you're offering, what's your lowest self-only cost, and then line 16, you're going to be able to say whether the offer was affordable or not. Now, if line 14 is 1A, your qualifying offer, you do leave line 15 blank. And for an ICRA, line 15 is the employee contribution It's the excess of the monthly premium for the lowest cost silver plan over the monthly ICRA amount, which we can get from your ICRA TPA. So again, you put in, if the employee contribution was the same for all 12 months, you can use the all 12 month box. But if you have like a non-calendar year plan, so January through June, the rate was $200 a month, but then July through December 31st, it changed to $210. You'll have to do it month by month. You enter the amount including cents. If the employee contribution is 0, you indicate 0.00 and do not leave blank unless you use the 1A code. All right, line 16 code always explains line 14. So line 16 code is your friend. It's what we call a safe harbor code. What does that mean? That means it's intended to explain line 14. Why did I not offer coverage? Or I offered them coverage that was, family coverage. So what happened? Was it affordable? And so it's used so that the IRS cannot assess an A penalty. There is no code for waiving coverage because the employer is explaining to the IRS if they offered coverage at all, what type of offer that was, and if that offer was affordable. So if someone waives coverage and it was affordable, your waiving coverage codes, for lack of a better term, are 2F if it was based on the W-2, 2G if it was based on the federal poverty level, and 2H if it was based upon the rate of pay. Now, one exception, you cannot use line 16 if you're only offering a MEC, because that's not a minimum value plan, and you can't use an affordability safe harbor. So let's go through this example again, and you can see how line 16 explains line 14. And in this case, Tom, the employee, enrolls. So Tom is not an employee in January of 2023. So line 14 is 1H, no offer. Line 15 is blank because there's no offer. And line 16 is 2A because he wasn't employed any day that month. The month of February, he was hired on the 10th. So line 14 is still 1H, line 15 is still blank, and line 16 is 2D because he's in a waiting period. Tom is eligible for an offer of minimum value family coverage, and he actually enrolls in that coverage for the rest of the year. So March through December, line 14 is going to be 1E, an offer of family coverage. Line 15 is going to be the self-only lowest cost plan, and in our example, we use $200. And line 16, 2C, because Tom enrolled in coverage. Now, let's say Tom does not enroll in coverage. Well, then your affordability safe harbors come into play. So January is still going to be the same. Line 14 is 1H, line 15 is blank, line 16 is 2A because he wasn't employed any day that month because he's hired in February. Line 14 is still 1H, line 15 is still blank, but your reason is different because now he's in a waiting period, so that's 2D. Even though Tom is eligible for an offer of coverage, he doesn't enroll for the rest of the year. So line 14 is still 1E, offer family coverage. Line 15 is the self-only lowest cost plan, unless it's an ICRA. And line 16 is based on the affordability safe harbor if the offer was affordable. So in this case, we're basing it upon Tom's rate of pay. So we can say, yes, it was affordable. And so the code you use is 2H. Okay, so ideally, it's going to be 2C if the individual enrolls, and it's going to be one of the affordability safe harbors if the individual does not enroll and it is affordable. Otherwise, you're required to leave it blank, and that is a trigger for the IRS to potentially assess a penalty if that individual is on the marketplace. So let's finally go through part 3, the self-insured part. So if you have a self-insured plan and that includes an ICRA, then you have to complete for what's called covered individuals. If your plan was fully insured for the entire calendar year, you leave Part 3 blank. So here's an example. So the employee and family members covered for any self-insured plan, including COBRA, you list the name of the covered individual. So your first name and middle initial if they have one, and last name. You put in their social security or their tax ID. You can leave it blank, but you're supposed to try to get the tax ID. You really need those tax identification numbers. You can enter a date of birth only if the TIN column is blank. And if the individual was not covered for all 12 months, you list every month the individual was covered. This rule is different than the offer of coverage rule because if they're covered for at least one day in that month, you can check the box for the entire month. So for example, I have a husband and wife, Tom and Sally Smith, and they have each been covered for all 12 months, but then they have Everett Smith, who's born in September 9th. So he's covered at least one day in September. And so you check the boxes from September through December. So let's talk about COBRA for a second. If you have a terminated employee, an offer of COBRA coverage to a former employee or former employee spouse and dependents due to a termination of employment should not be reported as an offer of coverage on line 14. Use 1H, no offer. Why? Because the employee is no longer full-time, so they're no longer accessible. So you don't have a requirement to offer them coverage. But if the plan is self-insured, you're still going to have to report them under the covered individual section under Part 3. Now, if someone is still employed, an offer of COBRA coverage that is made to an employee who remains employed by the employer should be reported on line 14 as an offer of coverage, but only for an individual who receives an offer of coverage. If the offer is due to a reduction in hours and that employee is still considered full-time under ACA, so that employee has been measured, they are in a look-back period. Their hours, they've reduced their hours in their stability period to under 30. Well, we all know that doesn't change their full-time status under ACA. So if you choose to offer them COBRA at that point, and the person chooses a marketplace plan for a subsidy, you can generate a B penalty on yourself if the COBRA, and it probably isn't going to be, is not affordable because you have to report the COBRA cost. So the rule of thumb is as long as people are in a stability period, they remain eligible for your plan. And to prevent penalties for offering COBRA, as long as they're in the stability period as full-time, they don't get offered COBRA until the end of the stability period when they fall off as no longer full-time. Break in service rules, you cannot treat people as a new employee unless you've had at least a 13 consecutive week break. The reason for this rule is for some reason the IRS in its wisdom thought that employers would hire people, then keep them on the rolls, then let them go, and then bring them back, and then not offer them coverage again or make them go through a new waiting period, which really isn't the way it works in the real world. But they're at least 13 weeks. You have to have at least 13 weeks of a break in service, or the rule of parity. So you have a break in service of at least 4 weeks, and the break in service exceeds the prior employment period. So somebody works for 3 weeks, then they have a break in service of 4 weeks. And basically the bottom line is you can't apply waiting periods. If someone leaves and they come back, make them an offer again. So with that, I'll go ahead and open it up to some questions. Again, for anyone who came on late to the call, that you get a copy of the presentation, and we do post this on our town benefit site, and I'll put where that is for you. I'll see if anybody has any questions. It's hard to believe that it's 2023, and I can remember starting to work on this in 2011. I'm sure some of you remember those initial years as well. So it's really become more run-of-the-mill. And again, just remember the IRS does require electronic filing this year. All right, well, I don't see any questions. So I will go ahead and gift you a little less than 30 minutes of your time back. I know this is a quick presentation, but we want to get to the information quickly and not belabor the point. So I would like to say thank you so much for attending today. It's an honor and a privilege to be of service to all of you. And I hope you have a wonderful afternoon and a wonderful Thanksgiving. Thank you so much.